Clint. Good to have you aboard from Morningstar again. Appreciate it's time for us to catch up in terms of what's been happening. Firstly, today I'll make a very quick disclaimer that whatever we talk about here is, of course, general advice, and specifically it doesn't refer to individual clients' portfolios. And of course, our clients of FutureGen can take that up with ourselves. But I'd like to welcome you today, and more importantly, talk about what's been happening in terms of yourself and how you've been managing these portfolios. As clients will be aware, Clint is the specialist portfolio manager for Morningstar and sits on the investment committee. So without any further ado, welcome, Clint, and what's been happening?
Hi, Murray. Good morning, everyone. And firstly, thank you for having me along. Well, it has been a fascinating period, hasn't it? Because we've gone through the biggest period of losses that we've really seen since the GFC for the average portfolio. And that's been followed by an extraordinary rally in share markets in particular over the second quarter and certainly the third quarter to date. So interestingly, net, if you just looked at the market or global share markets at the start of the year and now, they pretty much look the same, and so you'd be forgiven for thinking, what crisis? But as we all know, we've gone through a real roller coaster throughout March in particular, and then obviously we've rallied back in the subsequent months from there.
Should we be concerned, Clint? Should we be concerned?
Well, it's a really interesting point, and Howard Marks, who some of you may know, some of your listeners may know, as a very well-regarded investor. He has a quote which I might just share with you, because I think it sums up pretty well the situation that investors are facing themselves with, are facing at the moment. And that quote is, "The world is combating the greatest pandemic in a century and the worst economic contraction of the last 80 plus years. And yet the stock market, supposedly a gauge of current conditions and a barometer regarding the future, was able to compile a record advance and nearly recapture an all-time high. How could that be?" And we have actually recaptured that high anyway in the US and gone on to make a new high in recent days. But I think that very accurately indicates the conundrum that investors have at the moment, because when we look at our daily lives, many of us are in lockdown, certainly in the southern part of the country, in other parts of the world as well. At the very least, our daily lives have been significantly impacted by the COVID-19 restrictions. When we have a look at the economic data, perhaps it's been better than many expected, but it still hasn't been that good. And it's hard to see where the catalyst for a recovery comes. Perhaps it's to do with a vaccine, which may or may not be forthcoming. But then, so our real lives look quite challenged, the real economy, if you like. And then when we look at the share market, which, as Howard Marks alludes to, is a barometer of what future or investors are thinking about future conditions, then we see that we are on all-time highs in the US in particular. And so there's a real disconnect there, and I think investors are struggling to line those two things up. Now, we can make a case why US share markets have rallied back the way that they have. In part, that's going to be to do with the low interest rate environment that the central banks and governments have kind of supported, because they've come forward with so much stimulus to try and soften the economic blow of COVID-19. And when we look at some of the companies in the US at that top end of their market cap, we're looking at many of those IT and e-commerce type names that have been very, the themes around them are very strong, given we're all working from home and perhaps not able to go about our lives as we otherwise might. So we might be doing more online ordering, for example. We might be using more Netflix or other, those types of things because we can't go out and about to the movies and restaurants like we otherwise might. So we can make cases why share markets have rallied back the way that they have. There's no question there's a little bit of a behavioural bias creeping in there, in that investors see the strength of the rally and they feel like it's a better time to invest. Whether that'll be premature or not, we just simply don't know. Obviously, as COVID relates, we appear to be in a second wave of infection, but from what the share market is pricing in, the fact that shares are up around the level that they were at the start of the year suggests that investors are thinking, whatever the impact of COVID is, we've perhaps seen the worst they're comfortable that governments and perhaps central banks have those measures within their control. And that's certainly the outer year cash flows that investors are very interested in when they're valuing shares, that the fact that share prices are where they are suggests that they believe that they will be intact and not impacted.
Interesting. Yeah, I heard a comment also, Clint, from Warren Buffett very recently. He made the claim that the biggest risk to investing now isn't what return you'll get, but how to preserve your capital.
Yeah, so I think that's a very valid comment, and I think in many ways, your return is going to be dictated as much by what you don't own as what you do, and by that I mean it's really your ability to avoid those overvalued assets, because typically when you come into periods of volatility, it's those overvalued assets that are vulnerable to fall the most. And so I would agree with that. And what we're seeing in our valuation analysis at the moment, or what's been really characteristic in this last 6 or 7 month period, is we've seen very significant divergence in individual industrial sectors that make up the share market. So while we're talking about shares in aggregate, the S&P 500, for example, recovering those losses and making recent all-time highs, as I touched on there. When you actually dig a little bit deeper, the sector performance that makes up the S&P 500 has been very different. So things like IT has done well, as we touched on before. Some of the more defensive sectors like healthcare, to an extent consumer staples as well as consumer discretionary, they've been very well supported. But some of the sectors that have been particularly vulnerable to the economic outlook, like energy. So oil makes the world go round, as they say, and that's very the outlook for oil is obviously very dependent on the outlook for global growth, and the same for financials. So more specifically, banks need strong economy to lend and so forth. The outlook for those sectors in particular has become a bit more challenged, and so what you've seen is the shares fell much lower in that period of volatility that we had during March. And while they have recovered, they haven't certainly recovered anywhere near where they were at the start of the year. So it's been very much a period of divergence.
Very true, particularly when you see the reporting season results now between different companies, like and you see companies like Afterpay looking like it will now become an index stock.
Yes.
A company that doesn't make profit.
Yeah.
A company that is just remarkable.
Yes.
And you're seeing examples every day of companies, of a range of companies. There's winners and losers, isn't there? Big time.
Yes, and even if we switch back to the US, I touched on that point of divergence within the sectors, but what we've also seen is divergence among the market cap. So the top end of the market cap, the biggest companies, some of them very much in the IT space and the e-commerce space, they've really been doing the heavy lifting. But as you come down into the market, the smaller companies that make up the S&P 500, they actually haven't been enjoying as good a time. And so you're getting, very, very differing results depending on which part of the index that you're looking at, even if the headline looks actually pretty good.
So Clint, it really does mean, doesn't it? We can draw a conclusion from this that active management, in terms of managing that portfolio, in terms of what sectors you invest in, which stocks you buy, is preeminently so vital now, more so than ever. The days of people just buying into an index or exchange traded fund and just hoping it'll rise,
Yes,
I would suggest to you would be fraught with danger.
Yes, I think the thing with when you buy just an index ETF that's basically investing in the biggest companies, it's going to do that regardless of whether it's a good deal to invest in those big companies or whether those big companies are expensive. And so I would share we use ETFs and index ETFs frequently. They're part of our toolbox, if you like. We can blend them with other strategies to invest in certain markets. And Morningstar, as you know, very much an asset allocation house. So we'll make decisions around whether we like an entire market or a sector or in a country, whatever it might be. And so there are times there where it makes sense to use an ETF when the whole market is attractive. And as you know, we have investments in Japan and UK and others where the ETF is perfect for what are looking for. But then there's other situations where the index itself is actually not that attractive. And so we need to do something a little bit different in terms of sectors or stock selection to give us a reward that's a little bit better than what we might expect for the index, than what the index might deliver. And of course, reward for risk, I should add. There's always the two that go together.
And speaking on that mitigating risk, Clint, what steps have you been taking very recently to obviously mitigate risk, given what you've just been saying, and to get exposure to the right areas?
Yes. So this period, Q1 and Q2 2020, have been a fantastic demonstration of our process. And so what I mean by that is that when markets fell significantly throughout the month of March, we bought quite frequently throughout that period. We traded on 8 separate days throughout the month of March. And really, if you cast your mind back to that period, it was characterised by, very indiscriminate buying and selling, big moves in the index, not just locally, but offshore as well. And it was almost like every 1, 2, 3 days, something else was being inadvertently discarded that was actually quite a high quality business, and we had the chance to buy it temporarily on sale. And so that was very much Buffett's being greedy when others are fearful during that period. Excuse me. As we know, markets have actually rallied back quite significantly. And if anything, investors are starting to get a bit more complacent, we think, given the recent gains that we've seen and I guess the improvement in sentiment. And so more recently, our portfolio activity has actually been to start to build up our cash again. We're recognising that there's not as many bargains around now as what there was 4 or 5 months ago. We're still very happily invested in the assets that we were able to pick up at that time. And we touched on energy companies and financials a little bit earlier today. So we're still happily invested in those, but we're just being mindful that there's not as much opportunity out there as there was a few months ago. And that's because the risk of losing money is starting to get elevated a little bit. It's time for us to build up our cash buffers again.
Excellent. Well, Clint, listen, thanks for your time today. Very much appreciated. We understand that obviously risks are getting higher as we move forward. Obviously, the US election in November as well.
Yes.
But I think you've touched on a few key areas there that at this stage, rebuilding cash, taking some risk off the table, is probably the important theme going forward.
Yeah, and I think that's a very good summary. I mean, we're not predicting some major crisis. I mean, it's always possible, of course, but we're just doing what we do. We'll just continue to buy those assets when and where it makes sense to do so. And if we come into that environment where we just can't find as many bargains as what we once did, then we'll start to save some cash and wait for that opportunity to buy again.
Excellent. Well, Clint, I'd like to thank you for your time today, and we look forward to speaking to you over the next quarter.
You're welcome, Murray. Thanks for having me along.